Yesterday, this small semiconductor stock had a disappointing earnings in some respects, but in others, it surprised. This semiconductor equipment provider underpins the integrated circuit manufacturing process. And as advanced designs of ICs become even more necessary, this advanced manufacturer of the photomasks will benefit. It is a small cap stock, but is one of the very few manufacturers capable of creating such an advanced photomask for this fast-growing industry. It is also a big free cash flow producer, which will drive returns for investors. It is Photronics, ticker PLAB. Welcome to the Quality Investor. Today, I want to discuss the earnings of Photronics. It disappointed, to be sure, particularly because they missed their own guidance for Q2, and they missed that guidance by quite a bit. But while the income statement was a bit lackluster, they did strengthen their balance sheet as well as generated very strong free cash flow. This ensures their future growth and expansion as the semiconductor industry as a whole enters its next growth stage. This is going to be a quick video today. I'm just going to discuss the earnings and what I think their valuation is. But before we get into it, please make sure to like this video below and subscribe to the channel so you can stay on top of all the quality businesses in the market. Photronics finished the day at $26.32. You can see that big drop here when they opened the day after they released their earnings, down as much as or as low as $24.09. However, they did spend the rest of the day climbing slowly back up before closing at the $26.32. Year to date, it has not been much better. They're still down over 14% on the year. However, on a one-year basis, they're up 53%. As we head into the next growth stage for semiconductors, though, we should see some very positive returns for Photronics over the next few years. Starting out on their income statement here, you can see they had $217 million in revenue, which is up ever so slightly sequentially from $216.334 million last quarter and is down 5% year over year. On a year-to-date basis, through Q2, they are down just over 1.5% on the year. And even more disappointing, we saw the gross margins contract 2% from 38.5% last April to 36.5% this year. We don't like to see that margin contraction. However, there is a reasonable explanation offered on the earnings call by management. So on the surface, these results do seem pretty disappointing. However, there was an earthquake in Taiwan where 3 of Photronics' manufacturing facilities are located. That earthquake took those facilities offline for a few days, which of course stopped production and cost them nearly $3 million in the time down. So with that offline production, that of course would squeeze margins. However, on the call, they also noted that since those facilities came back online, they have seen an increase in orders, as well as the overall semiconductor industry improving. Another thing to note here is that year over year, their operating margin is also down 3.4% to 25.8% this past April. The reason for this, however, is an increase in the R&D spend. You can see that here, 4.3 million versus 3.4 million last year. They noted on the call that the higher R&D spend is what they call qualifications for their photomasks. I don't know the technical details behind it, but they did say it's indicative of higher demand, and they're seeing that ramp up throughout the rest of the year. All of this, of course, led to a lower earnings per share at 58 cents this year compared to 65 cents last year. However, on a year-to-date basis, they are actually higher at $1 versus 88 cents through the same time frame last year. But like I mentioned earlier, what they did in lieu of a poor sales quarter was they strengthened their balance sheet. Photronics now has more cash than they've ever had before, over $500 million in cash. Compare that to their debt, $20 million in short-term debt and only $2.5 million in long-term debt. They have far more cash than they do debt. They have far more cash than they do liabilities. They also increased equities by nearly $100 million as well. So a very, very strong balance sheet. This bodes well for their future growth. They're very well positioned to take what they have on their assets and use that to drive their future growth. When I get to their earnings presentation, I'll get in a little bit to what that growth is. And despite that poor showing on the income statement, you can see year to date, they're up over last year at 95 $88.5 million in net income versus $88.2 year-to-date last year. They've also had very strong cash generation. And like I always say on this channel, free cash flow is what leads to strong returns for investors. And if you take that number there, you can see that year-to-date, they currently have $55 million in free cash flow compared to only $52 million year-to-date last year. So despite being far behind on a trailing 12 basis for revenue, they're actually ahead right now on a trailing 12 basis for free cash flow. I think the big drop today was because they were far behind their stated guidance from Q1, but the market quickly saw how strong their balance sheet is, as well as how well they generated cash flow. And that's why we saw that bit of recovery in the market today. So this is one of the slides from the earnings presentation. And I just want to point out, this is what they are saying as the long-term trends driving photomask demand. They were very adamant on the call that they're optimistic about the future demand for integrated circuits and flat panel displays. Those are their two segments. What they're seeing is that customers are migrating more and more to the smaller, more advanced designs. And you can see down here, growing competition drives innovation and greater mask value. One thing to understand about Photronics is their growth is not necessarily dependent on increased sales, but is actually more dependent on design activity. What that means is the more competitive that this integrated circuit market becomes, the more advanced that these photomask designs need to be. There's only a very small number of firms out there that can create these ultra advanced designs. Photronics is one of them. Because there's such an important bottleneck in that whole supply chain of semiconductors, one core of my investment thesis for them, their advanced capabilities is what's actually going to drive their growth. They have that high barrier to entry due to their high technical expertise. They also mentioned AI quite a bit on the call. They expect AI to drive design activity across the entire AI ecosystem. They didn't quite elaborate on what that ecosystem is, but given what NVIDIA's earnings were last night, that ecosystem is becoming more and more advanced. All right. Before we get to the valuation, I do want to show you the guidance for Q3. They're projecting revenue to be between $221 million and $229 million. Now, if they hit the midpoint of that guidance, that will be an increase year over year. If they hit the high end of that guidance, not only will it be an increase year over year, it will be higher than what they did in Q4 of last year as well. They're also projecting operating margin to be between 28 and 30%. Again, the midpoint would be higher than last year. And I think these projections are showing their confidence that the semiconductor industry is rebounding, and we should see that strength, that new growth happen in the second half of 2024. They also left their full year CapEx guidance at $140 million. Because they beefed up their balance sheet this last quarter, they're able to continue investing for their future growth despite lower than expected sales from Q1 and Q2. They mentioned on the call that they saw a rebound in the bookings at the end of the quarter. And combine that with the overall confidence on the call management had in the near term, I think that's why we saw the rebound in the share price throughout the day, despite opening down pretty significantly over 8%. So let's compare the results so far through April with how our projections for year one looked. So right now we're actually slightly ahead of our revenue projection. Despite being down negative 2.4% against the trailing 12, we're about 0.25% ahead of what we projected for revenue in 2024. For operating income, we're ahead of our projection by about 1.5%. I actually did lower my projected operating margin for the year. I had it at 27% originally. I did lower it to 26% because we are seeing that decrease in the margins due to the extenuating circumstances last quarter. For net income, however, we're ahead pretty significantly. 13% ahead of what we had projected for net income. And you can see year to date, those higher numbers are being reflected in that trailing 12. So the 39 and the 56 for Q1 and Q2 ahead of 29 and 59 the same period last year. We are behind on our earnings per share, however. I think I had a higher share repurchase projected than what is actually going to happen. In fact, it appears that their shares might grow a little bit in this year, but free cash flow wise, we're far ahead of our projections. I projected at $73 million in free cash flow for 2024. We're almost at that through Q2 of 2024. I had a 57% decline in this fiscal year. Even factoring in the other two quarters from last year, declining another 57%, we would finish at $106 million in free cash flow this year, nearly 50% ahead of what I originally projected. My point is, this is a cash flow machine. Photronics does a very good job generating cash flow for investors. They have very efficient processes. And as their margins expand, that's only going to increase how much cash they're generating from operations. And once the semiconductor industry truly rebounds, we're going to continue to see that strong free cash flow growth that we've seen in the last 4 to 5 years from Photronics. So what does our final valuation look like for Photronics? Well, for DCF, for my bear case, I have them at $38.42, $45.97 for my base case, and at $56.85 for my bull case. Currently, they're sitting at $26.32, and you can see that's a pretty sizable upside regardless of which case happens. For context behind that, for my bear case, I'm projecting free cash flow to decline 2.75% per year over the next 10 years, and I'm projecting free cash flow to be flat for my base case over the next 10 years, as well as free cash flow to increase by about 2.75% for my bull case. Just on a discounted cash flow basis, this stock appears to be very undervalued right now. I'm not sure if the market just doesn't recognize the strength of the balance sheet or how much cash this business really generates. They're not a high growth business in terms of sales growth, certainly not like an Nvidia, but they compound free cash flow. And that's what investors want at the end of the day. So given no margin of safety, I have a forward PE of about 17.6 here for a $46.90 buy price. That is their average PE over the last 10 years. That's $46.90. That, of course, is no margin of safety. And in fact, I would probably put them around a 35 to 40% margin of safety. Originally, I had this business at about 30% margin of safety, but even I cannot believe the numbers that I'm seeing here. So I'm recommending about a 40% margin of safety. Of course, this is not financial advice, which means they have a buy price of about $28.14. That's a slight multiple expansion on the PE, 10.6 versus what it's at now at 9.9. So given the almost monopolistic economics of Photronics, couple that with the very strong future growth projections for the semiconductor industry as a whole, and the necessity of their product within that semiconductor ecosystem, Photronics is poised for a long run of growth. They're very cheap right now. They're well below their 5 and 10 year averages on the PE and on a forward PE. Their margins are expanding. They are a bit on the low side of ROIC, lower than what I normally like at about a 15%. However, I believe once they get into the next stage of their growth cycle, that will expand. They've had a lot of capital expenditure in the last couple years. It's going to slow down a bit in the future, and we're going to start seeing those returns materialize in the next 2 or 3 years. But like I said, this is not financial advice. This is a small part of my portfolio right now, but it is a very strong stock, very solid company, excellent fundamentals, and in a very high growth industry. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.